What is the biggest misunderstanding about money that prevents people from actually building more wealth? Is it the fear of what's coming or not knowing what to invest in, that they'll lose it all if they invest it? Like, what's the biggest misunderstanding about money that's preventing people from building wealth?
There's one thing that differentiates what rich people do and what everybody else does. And it comes down to what your knowledge is based around. I'm telling you this from experience because I grew up in a traditional Indian house where knowledge means go to school, study hard, get a good degree as a doctor.
Mm-hmm.
We're not talking about any other career, get a good medical degree. That's what it meant, because if you have a good career, if you have a good degree, you are set for life. Wealthy people and those who become wealthy realize that there's a different game of that formal education versus financial education. And once you understand that, now you can start change what you learn. Because what the average person does, because we're all taught this, it's we work hard to make money. But no wealthy person is working hard to make money. Their money is working hard to make them money. And that concept is so foreign for the average person because we're never taught that in school. And this is the problem, is why do we go to school? We go to school so we can, get a good job? Why? So we can get paid? Why? So we can ultimately have some freedom. But there's a big gap there because that freedom comes from having wealth. But your job is not what's going to make you wealthy. It's your financial education that's going to make you wealthy. Mm-hmm. Where is that financial education taught? I didn't learn that in school.
No.
Did you learn that in school?
No.
And that's that difference. So you talk about now, what is the biggest fears? When you don't have the financial education, you now get caught up in doing what you think is right because everybody tells you it's right, but you don't realize the true cost of this. For example, the average person goes to work, and when they're financially smart, the average person, they go and they save that money in the bank. Well, why do you save your money in the bank? So I can get paid some interest, right? Well, what if I told you that the average person is not getting paid interest? They're actually paying their bank interest. You're going to say, well, what are you talking about, Justin? My bank says that they pay me 0.5%. They pay me 1%. It pays me 2% interest. No, you're being lied to. You're the one that's paying them interest. Because when you take the $100 bill and I deposit it in the bank and they give me a note saying I'm getting paid 1% interest, well, the $100 is growing to $101 after 1 year. But the average inflation rate in America is 3%. And that's the reported inflation, not the real inflation that many people feel, because real inflation is actually higher than that. So if real inflation or reported inflation is 3%, my $100 grew to 101, but something that cost $100 now costs 103.
You're losing money.
I'm effectively poor, but that's not all. What happened with the bank? Because as soon as you take the $100 in the bank doesn't just keep the money in a vault. They immediately take that money and they lend it out to somebody else. So they take the $100, they pay you 1%. Now I'm going to charge you 6 or 7% when you want to get a mortgage. I'm going to charge you 18 to 25% when you get a credit card. But you get that 1% thinking, I'm getting rich, I'm getting this interest. But in reality, you're the one that's paying the interest because you are losing value. And right now, our economy is changing because our dollars are losing value. And I don't say this in a very general way. I'm saying this because in 2015, it was one of the worst years for the dollar in the last decade, which means the dollar has lost value. What does that mean? Because the average person thinks that this is some fancy Wall Street jargon. But what that means for the average person is that means it costs more money to buy stuff. Groceries are more expensive. Rent is still more expensive. Going on a vacation is more expensive, while salaries are not keeping up. And so now when you're working hard to make money, you're working hard to save money, you think you're doing the right things because you got a good job, you're working hard, but you're working hard in the wrong direction. And it sucks to hear that because we're taught that that's the right thing to do. But when you start studying what wealthy people do, you realize that they're playing a very different game with a completely different rule book, and we're never taught that. And that's what frustrated me. That's what the only reason why I started creating these YouTube videos is because when I learned this, I was so angry because I did not grow up learning about money. I knew that I wanted to be financially successful. That way I could give back to my dad because I saw how hard he was working.
Mm-hmm.
But we didn't have that financial education. I didn't know investors. We didn't grow up with that around us. But the people that grow up in that circle, they understand. Wealthy people are not working to make money. They're working to own the assets so these assets can make them money. How do you do that? You have to know how to use this money to buy investments. And now the average person thinks that when I go out and I save money and I buy my house and I have my 401k, I'm secure. Well, I'm telling you from experience, because I've been doing this for a long time. In our firm, we've been teaching and working. One of our top members, these are people with 401ks and homeowners. Well, here's the problem. I'll start with 401ks. It's a great place to start. The founder of the 401k has come up publicly and said multiple times the 401k has gone awry because the average person believes now that the 401k is all I need to be able to retire. I own a house, I have a 401k, I'll get Social Security, it's enough to retire. That was never the intention with the 401k. It was there to supplement your retirement. It's not bad to have a 401k, but you have to know how it works. The second thing is the average person has no idea what the 401k is costing them because your 401k has a fee. NerdWallet did a study. They found that like 90% of Americans don't know what the 401k fees are. It's called an expense ratio. So as soon as you open up the 401k, you get the money deposited into it. The fund that you put your money into is charging you a fee every single year. And the average 401k fee, according to a Kiplinger report in 2025, for somebody under $1 million in assets is 1.26%
A year.
a year. Now, that might not sound like a lot.
But over 30 years.
Over 30 years, that could end up costing you hundreds of thousands of dollars because it's a 1% fee that you pay every year on every dollar that you invest, plus every dollar of profit over the course of your investing career. And so you have to understand now, you need more money to retire. Why? Because the cost of living is going up. A lot of people used to say, man, if I had $1 million, man, I'm set. Nowadays, that $1 million doesn't buy you what it could. USA Today says Americans need $1.5 million to retire now. Not lavish, comfortable retirement. Well, the average person is nowhere near hitting that $1 million or $1.5 million. And now we get into this problem of, okay, I had the 401k. I'm not going to have enough. Social Security is not paying enough. Maybe my house is going to supplement that and I'm going to be good. Well, hate to break it to you, Lewis, but your house is not going to put food on the table because it doesn't pay you an income.
It's an expense.
It's an expense.
Property tax, fixing stuff, all the expenses.
The insurance.
Everything, man. It's expensive.
And now they say, well, what if I pay off my house? Okay, great. You paid off the house, but now you still got the property taxes and the insurance. And let's say, Lewis, you bought your house in a great area. Well, let's say you bought a $500,000 house. You bought it in a great area. Now it goes up to $1 million. You're going to say, Jaspreet, look at me. I got $1 million asset I'm sitting on. Good. I'm happy for you. Now you have to pay property taxes on $1 million house because if your house goes up in value, so do your property taxes every year. You have to now insure $1 million house.
Yeah.
And now what happens is maybe you have an income from your job to keep paying that, but what if you stop working? Maybe you retire, maybe you can't work, you still have to pay these expenses. Or maybe now you built this house, you paid it off, you were able to support the cost, and now you pass it down to your kids. Well, now your kids have to pay to support this $1 million house. And why do now so many of these kids have to liquidate the house and sell it? Because they can't afford the cost of just keeping the house. So now we think that buying this house is going to make us wealthy, when in reality, that's not always true. Now, I'm not saying it's bad to own a house. I'm not saying you shouldn't own a house. In fact, it's a very good thing to own a house and pay it off. But the mistake that many people make is they think, Jaspreet, I'm going to get a good job, invest in my 401k and buy a house and I'm going to be set. When you have that sort of mindset, you're thinking like everybody else. And right now, America is facing the largest retirement crisis of history because everybody thought if I got a good job, I invested in my 401k and I owned a house, I'm going to be set. Just do the math. If those are the people now that are facing this retirement crisis, What makes you think that it's going to be easier for you when we have a more volatile stock market, where inflation is a bigger problem now than it was for the previous generation? What makes you think that all of a sudden it's going to be easier for you? They say the definition of insanity is doing the same thing and expecting a different result. Well, here you are. And so when we think about the house, I'm going to talk about one more thing about it, because then people will say, well, Jaspreet, if I have to pay $3,000 a month, isn't it better for me to build equity as opposed to making my landlord richer? Yes. But that's not always what's happening. Because when you get a 30-year mortgage and you're paying $3,000 a month, it's not $1,500 going to your bank and then $1,500 going to principal.
No, 80% is going towards
interest. In fact, more in the beginning. And so it's not for the first 15 to 20 years of your 30-year mortgage that more than half of your payment is going straight into your banker's pocket with interest. And then the other small percentage is going to your principal. And now we have to assume that you don't do a refinance, because if you refinance on year 8, well, now you start the process all over again. And so, again, I'm not against you owning your house. In fact, I would prefer you to own your house than rent it. The mistake that people make is I buy my house thinking that it's going to make me rich. So how about you buy a little bit bigger, a little bit nicer, because it's the biggest investment of your life. And when you think it like that, and I'm telling you, and I speak from experience, because I worked as a realtor. And in that sales training, what did they teach you? You are selling the best and biggest investment of somebody's life. Easy to get you to buy bigger when I'm selling you an investment, right? I'm not selling you an expense. Hey, Lewis, here's the biggest expense of your life. This is the biggest money pit hole you're going to have. I'm not going to sell.
Yeah, no.
If I say, Lewis, this is the best investment. This is an investment for your kids.
Yeah, your family's going to have memories here for decades. Yeah.
And it makes sense. But when you start to do the math, you realize that maybe owning the house isn't as good of an investment as you originally thought. And so this is where now we start to realize maybe some of the things that I was taught was wrong. If you're willing to get over the hump, because sometimes we have that ego, and I had that too. But once you start to realize that, oh crap, I need to do something different, now you realize, what I realized was everything that I was told was a lie. And I need to restart my learning. And it's difficult once you've built a degree, you built the job, you built that foundation. And now you're like, oh crap, I got to start over. But you're not starting over. What you're doing is now just shifting the direction. Yes. And now you can start to accelerate the path towards wealth, which will give you that true freedom.
You know, if someone's watching or listening to this right now thinking their entire life has been lied to about money, finances, how to invest, if I do these things, then I'll be safe in the future. What would you say then are the 3 biggest money rules that wealthy people do that most people aren't following?
Well, I think you can break it down into 3 steps, because there's 3 stages of wealth. And I'm going to break it down into phase 1, getting the money.
Yeah.
Phase 2, growing the money. Phase 3, protecting the money. Phase 1, getting the money, is all about now, how are you going to just lay the foundation for your finances? How are you going to make money? And people say, well, what business should I start? What job should I get? I don't care. Do what you believe is right for you. Sometimes it's what you like. Sometimes it's not what you like. But you gotta figure out how you're going to earn money. Figure out how you're going to earn more money. And then create a system for your money. So here's a few basic rules. Number 1, if you have credit card debt, if you don't have $2,000 saved up for an emergency, you are in what I call the financial danger zone. Now, I'm going to probably upset some of your listeners right now, Lewis, but I'm going to do this because I want people to be better with money. I don't say this to make friends. If you have credit card debt, or if you don't have $2,000 saved up, you should not go and see the inside of a restaurant. You should not go on another vacation. And you should not have a Netflix subscription.
Or go to Starbucks or... Yeah.
All of those little expenses are destroying your finances. Now, why am I saying no Netflix? It's not because of the $15 a month. is because the average American is watching more than 2 hours. It's actually over 3 hours, but I like to say 2 hours, more than 2 hours of TV a day. And if you're broke with credit card debt, without $2,000,
You don't have the luxury to watch
you don't have the luxury to.
Yeah.
You need to use that time to earn money or learn, develop those skills
to earn money.
Now, the reason why I'm so aggressive about this is because let's assume now you got a little bit of cash saved up. You got $8,000 saved up in the bank right now. If you took the $8,000 today and you invested it, and you could get a, let's just say 20% return on your money for the next 40 years, you're not going to retire with $500,000. And I'm also going to assume that you never invest another penny again. Only the $8,000 today. You're not going to retire with a $500,000 or $1 million or $2 million or $5 million or $10 million. You're going to retire a decamillionaire with over $11 million. Now you're going to say, Jaspreet, that sounds pretty good. Sign me up. I got $8,000. Well, here's the reality. You're probably not going to get those returns. Do you want to know who is? Amex, Visa, Discover, MasterCard, and you're the one that's paying that. Because the average American household with credit card debt has $8,000.
Wow.
The average APR on credit card debt is 20%. So if you, instead of making them rich, took that money and you could get those same returns, you would be incredibly wealthy. But that's why they're flying high in private jets with those big buildings. It's because you're working hard to make them rich. So when it comes to that getting money, you got to first lay that foundation, get out of the financial danger zone, and then create a system for your money. I like to teach 75, 15, 10, which is for every dollar that you earn from here on out, 75 cents is the maximum that you can spend. 15 cents is the minimum that you invest. 10 cents is the minimum that you save. This way, now every time you get paid, you're always putting money aside to save and invest before you spend all of your money, because what wealthy people do, we talked about, is their money is making them money. How do they do that? It's because they own the assets. How do they get that? Because they take their money and they don't spend all of it. They always have money to save and invest before they spend all of it. So create 3 bank accounts. Don't do this all of one. One for your spending money, one for investment money, one for your savings money.
Yeah, 75, 15, 10. 75% of every dollar, the maximum you can spend is 75%, is what I'm hearing you say.
Yep.
The minimum is 15% to invest, and the minimum is 10% to save. And imagine if you could do the minimum to invest would be 40% of every dollar. That'd be incredible. If you're able to invest more than just 15%. You may not be able to with expenses, but imagine if you bump that number up every month. It'd be powerful.
And that's now goes into the mindset of how do you build your wealth? Because the first, I'm going to take a step back here, because anytime we talk about money, a common feeling that I think a lot of people feel is, I don't know, Jaspreet, I don't feel right about talking about money, and I don't feel right saying I want to be wealthy.